Your bank just sent you a mortgage renewal letter. Somewhere on that letter is a number, your new interest rate. Most Canadians read that number, think it sounds reasonable, and sign. That decision costs the average Canadian homeowner between $10,000 and $15,000 over their next term. And the bank is counting on you not knowing that. I'm Aleem, and this is my YouTube channel, Mortgage Free Faster. And today I want to walk you through the mistakes I see Canadians make at renewal time and exactly what you should do instead. Here's what most people don't realize. Your mortgage renewal is not just a formality. It's the single most powerful financial moment you have as a homeowner. When your mortgage comes up for renewal, you're not locked in. You're free to shop around. You can negotiate your rate, your term, your payment structure, everything. But most Canadians treat it like they're renewing a gym membership. They get the letter, they sign, and then they move on. And before we even get to the rate, most people walk into renewal without asking the questions that could change everything about their financial picture. Not just their mortgage, their whole financial picture and situation. That's where I want to start. Before we talk about what rate to sign at, there are 5 questions I ask every single renewal client, and none of them have anything to do with rate. First, do you have any high interest debt? Credit cards, car loans, lines of credit. If you're carrying debt at 19 or 20% and you have equity in your home, renewal is the moment to deal with that. Rolling high interest debt into your mortgage that you have not been able to pay off at a rate of 4% instead of bleeding out at 20% can save you hundreds of dollars per month. Your bank will never bring this up because it benefits you, not them. Second, what are your plans over the next term? Moving, renovating, growing your family, starting a business? The structure of your mortgage has to match where your life is headed. Locking into a 5-year fix when there's a reasonable chance you'll need to make a change in 2 years is an expensive mismatch. I've seen it cost people tens of thousands in penalties that they never saw coming. Third, how stable is your income? If your income fluctuates, self-employed, commission, seasonal, some lenders are going to work much better for you than others. And if rates move during your term, can your budget absorb a payment increase without it becoming a real problem? This shapes the entire fixed versus variable conversation. Fourth, do you think that you'll need to access equity before the next renewal? Almost everyone says no, and then life happens. A renovation, helping a kid with a down payment, an investment opportunity. If there's any chance you'll need that equity midterm, we need to build that into the structure today. Setting up a HELOC component now keeps the door open without the cost of breaking your mortgage later. Fifth, can we do a straight transfer? If you put less than 20% down when you bought, you might have an insured mortgage that qualifies to transfer to a new lender at insured rates. No refinance, no inflated costs, often with legal fees and appraisal covered. Most people don't know this exists. The bank certainly isn't going to bring this up. This assessment before anyone talks about rate is what separates a real renewal conversation from just signing a piece of paper. Now, let's get into the 3 mistakes. Mistake number 1, accepting the bank's first offer. The rate on the letter is not their best rate. It's their opening rate. It's what they're hoping you'll sign without asking questions. Banks have posted rates and they have discretionary rates. The discretionary rate is what they can actually offer if you push back or show up with a competing offer. The difference between these two numbers can be anywhere from 0.1% to 0.5% depending on the lender and the market. On a $600,000 mortgage over a 5-year term, a difference of just 0.5% works out roughly to $7,500 in extra interest. Push for 0.5% and you're looking at $15,000 or more. The bank will give you the better rate, but only if you ask, or better yet, only if you have a broker doing it for you. Do not sign the first letter. Get at least one competing offer before you respond to your lender. That one step alone can save you thousands. Mistake number 2, choosing your term and rate type based on habit instead of your actual situation. Someone had a 5-year fixed mortgage. It comes up for renewal. Without much thought, they sign another 5-year fixed because that's what they've always done. Here's the thing. The right term for you depends on where you are in your life right now, not where you were 5 years ago. Are you planning to sell in the next 2 or 3 years? A 5-year fix might lock you into a penalty that wipes out any savings. Planning to refinance to access equity? Same issue. Fixed versus variable is a real conversation that deserves more than 30 seconds. Whether variable makes sense for you depends on your income stability, your risk tolerance, and where you think rates are heading. That answer is different for every person. but it's worth sitting down and actually running the numbers, not just picking what sounds safe. Mistake number 3, waiting too long to start the renewal process. Most Canadians know their renewal date. What they don't know is that most lenders will allow you to start the renewal conversation up to 120 days out. Some go as early as 180 days. That window matters because if rates are favorable today, many lenders will let you lock in now with no penalty. But here's what almost nobody talks about. There's language buried in most Canadian mortgages that most homeowners never read. And if you know how to use it, the window to start this conversation doesn't open at 120 or 180 days. It opens at the 13-month mark before your renewal date. That's over a year out. Beginning the conversation there, using what's already written in your mortgage agreement, can potentially save you a significant amount of money. It's not a loophole. It's already in your contract. You just have to know that it's there. I've put together an entire framework around this. I'll link it in the description. If your renewal is coming up in the next year, watch that one next. The big takeaway, don't wait until 30 days out to start this conversation. Most Canadians negotiate under pressure with no time and no leverage. The homeowners who win at renewal start early, sometimes much earlier than they realize that they can. Let's put this all together. Before you even touch the rate, do the full assessment. High interest debt, your plans, your income, your equity needs, and whether a straight transfer makes sense. That conversation alone can save you more than rate negotiation ever will. Then, do not accept the bank's first offer. Always get a competing offer. A mortgage broker does this for free and can shop multiple lenders at the same time. Then, actually review your situation. Your life has changed since your last renewal. Your mortgage strategy should too. And start early. The 13-month mark is when you have real leverage. I've linked the full framework in the description. Whether any of this makes sense for your specific situation, that's a personal conversation. The numbers look different depending on your lender, your balance, your plans, but these shifts are what separate homeowners who are quietly overpaying from homeowners who are mortgage-free faster. If you want to walk through your specific renewal situation, the link is in the description. If you want to email me, I've got my information there. And if this was useful, subscribe. Every week I break down the stuff that your bank hopes that you never ask about.